Somewhere in Manhattan, a man is worth $9 billion. But it isn't his company that made him rich. It's the dirt underneath it. That pattern, building something incredible, then quietly converting the profits into land, isn't new. It's ancient. Tonight we're tracing 2,000 years of financial history to answer one question. Why does owning property consistently outlast, outperform, and outlive everything humans have ever built? A farmer plants a field in ancient Rome. Centuries pass. Empires fall. The field is still there, still worth something. Meanwhile, the businesses, the guilds, the trading companies of that same era? Gone. Vanished into historical footnotes. This isn't a coincidence. It's a pattern repeating across Rome, feudal Europe, the Gilded Age, and Silicon Valley. Let's go back to where it started. In ancient Rome, soldiers who served the empire were paid in one thing above all: land grants. Not gold. Not shares in a trading company. Land. Roman senators were legally required to hold land. Trade profits were considered beneath the elite. Land wasn't just wealth. It was status. Fast forward to feudal Europe. Lords owned the land. Serfs worked it. Titles passed down for generations, tied permanently to acreage. Craftsmen and merchants built thriving businesses in this era too, but without land, they had no real political power, no lasting legacy. Then came plague, famine, and war. Trade routes collapsed. Guilds disbanded. But land? Land simply changed hands. It never stopped existing. In 1086, England's Domesday Book recorded nearly every plot of land in the kingdom because land, not commerce, was considered the true measure of a nation's wealth. Merchant fortunes, meanwhile, rose and crashed with every shipwreck, war, or bad trade deal. Volatile. Land appreciated slowly, but it never went to zero. By the Renaissance, successful merchants understood this instinctively. Once a business made them rich, the very next move was always the same. Buy land. Buy villas. Buy estates. The Medici family didn't just bank money. They built land holdings that outlasted their banking empire itself. The business was the ladder. Land was the house you built at the top of it. This pattern crossed the Atlantic. In colonial America, land ownership didn't just mean wealth. It meant citizenship, legal standing, even the right to vote. The homestead principle was radically simple. Claim land, hold it, and its value grows from settlement alone. No product, no customers, no risk required. Early American manufacturers, meanwhile, struggled constantly. Competition, fires, floods, and failed ventures crushed most of them within a decade. The land beneath those failed factories? It kept its worth, and often kept rising. Even the founding fathers proved the point. Washington, Jefferson, their true fortunes weren't political careers. They were acreage. Thousands and thousands of acres. Now fast forward again, to the Industrial Revolution, when fortunes seemed to explode overnight in steel, oil, and rail. But look closer at who actually won long-term, and the pattern holds. John Jacob Astor made his first fortune in the fur trade. But his real fortune came from quietly buying land across a growing city called Manhattan. Astor understood something simple. Businesses can be copied, undercut, or destroyed. Land in a growing city is finite, and finite things become more valuable over time. Cornelius Vanderbilt built a railroad empire, but it was the land grants running alongside those tracks that kept generating value long after the trains slowed down. Andrew Carnegie eventually sold his steel empire entirely, and moved much of that fortune into land, bonds, and hard assets. Rockefeller's Standard Oil was famously broken apart by antitrust courts in 1911. But his land holdings? Untouched. Unbreakable by regulation. That's the asymmetry. Businesses face competition, lawsuits, disruption, and obsolescence. Land, historically, faces almost none of that. The 1929 crash wiped out company stocks overnight. Fortunes erased in days. Land values dipped too, but they didn't vanish. The businesses did. Walk through Detroit today. Auto factories that once employed thousands now sit closed, obsolete. replaced by automation and foreign competition. But the land those factories sat on? Still zoned, still developable, still holding real value. Every generation, business fortunes churn. New companies replace old ones constantly. Land ownership, historically, just quietly compounds. After World War II, the GI Bill triggered a suburban housing boom. Millions of ordinary families bought their very first home. That single home often became the average family's largest financial asset. Bought for a few $1,000s, worth hundreds of thousands decades later. Meanwhile, small businesses started that same year. Restaurants, shops, workshops, mostly disappeared within 10 years. The house down the street from them? Still standing. Still worth more. Even the board game Monopoly, invented in the 1930s, encodes this exact lesson. Buy property, collect rent, and bankrupt anyone who builds nothing but businesses. Later, real estate investment trusts, REITs, let ordinary investors own property at scale, without ever swinging a hammer. Compare that to startups. Roughly 90% fail within their first several years. Real estate doesn't need explosive growth, just time, and a little leverage. Leverage is the quiet superpower here. A mortgage lets an owner control a large, appreciating asset using a small amount of upfront cash. Businesses rarely get financing terms that generous. And with rental property, tenants, not the owner, pay down the mortgage every single month. The asset appreciates and generates income at the same time. Very few businesses offer both this reliably for this long. Today's billionaires still follow the exact same instinct. Tech founders build history-making companies, then quietly buy farmland, ranches, and real estate portfolios. Bill Gates, for example, became one of the largest private farmland owners in America, not through farming, but through converting business wealth into land. The headlines always cover the company. The land purchases are what make the fortune durable for the next 100 years. To be clear, this isn't an argument against building things. Build the business. Take the risk. Innovation matters. But history's lesson, repeated for 2,000 years, is what you do with the profits afterward. You convert them into something that can't be disrupted. Empires fell. Factories closed. Startups failed. The ground beneath every single one of them is still there, still appreciating. That's the financial history lesson hiding in plain sight. Not hype, just a pattern, recorded again and again across the centuries. So the next time you build something incredible, ask yourself what you'll do with the profits. History already knows the answer.